Now we move to session 3, which many have already alluded to beforehand, because obviously the war in Ukraine is on all our minds, and it has a big impact also from a macroeconomic perspective. The question of Harald was also hinting at that beforehand. And this is why I'm also very happy that we have with us today Ms. Collette Mari Wheeler from the World Bank. She's a senior economist. And the World Bank has recently published a new report on war in the region. So we will hear firsthand about this report. And obviously, we'll not only hear about the risk related to the war and the impact of the war, but also climate-related risks. And with this, Collette, I'd like to give you the floor.
Thank you so much, Michaela. And also a huge thanks to Nelly for the kind invitation today. It's a pleasure to join everybody. I'm going to share my screen now. Go ahead. So we are actually fresh off of a new report that we recently published as of 2 days ago now, the Global Economic Prospects Report. So I'm going to talk a bit about what the outlook looks like on the global economy side. Can I just confirm that everyone can see the report, the PowerPoint okay?
Yes, all good.
Okay, great. Awesome. Thank you. Okay, so diving right in, I'm going to address from a global economy perspective, largely because our client countries, they are deeply affected by what goes on the external side. Especially given their deep and tight economic integration. And now when I refer to ECA, that's going to be Europe and Central Asia, I think what you all call EECEA. So largely we'll be addressing 3 main questions. What are the global and ECA growth prospects? We're going to look at the hot topic on everybody's mind about stagflation and what does this mean for the region, and what policy lessons can we learn, especially as we go throughout this green transition over the next decade, considering the shorter term shocks. So giving a little bit of insight on the global backdrop. Well, I wish I had better news, but we've seen a lot of deterioration on the global environment, especially since the invasion of Ukraine. But kind of backing up a bit, we saw what happened during the pandemic trough, that commodity prices collapsed in 2020. But since then, they've rebounded really strongly, which you can see here on the left-hand chart. And that's not just because of the war in Ukraine. For example, 3/4 of the oil price increase since April 2020 had already happened prior to the invasion. And many commodity prices now are near historic highs. So it's a very different market that we're in these days. And alongside that, financial conditions have also tightened in emerging market and developing economies, which I will refer to as EMDEs. We are now seeing levels beyond what we saw in March and April 2020. And so in advanced economies, they continue to tighten as we speak, but you can see here on this middle chart that for our client countries especially in Europe and Central Asia, conditions have tightened pretty dramatically. And that's not just because of the war. I mean, that's a large part of it, but we've seen a lot of monetary policy tightening, which I will talk about in a bit. And then on the trade side, things have continued to weaken. Supply constraints that we had hoped would dissipate by now, they've continued, especially China in March and April with the lockdowns. This caused an exacerbation of the supply bottlenecks, and we're expecting now trade growth even slower than we had about 6 months ago. So basically, we see a really weak global backdrop, which could have implications for investor risk appetite. And so what does this mean for our forecast, our outlook? So global growth will essentially have, from a very strong 5.7% last year to 2.9% this year. And then it'll stay about that pace for the next 2 years. Now that's a much steeper slowdown than we had envisioned in January. And of course, this is largely due to the war in Ukraine, but it's also due to faster policy tightening or monetary policy normalization, especially in the United States, as well as downgrade to China because of the COVID-related lockdowns. And you can see that very clearly here in our chart. We've had forecast downgrades across the board, pretty much in 70% of our economies that we cover. And the only group that we've seen that's kind of escaped this deterioration has been energy exporters. And of course, that has to do with the sharp increase in energy prices. And so again, back to our forecast, most of this is largely due to the war in Ukraine, but it's not all of it, as I mentioned. And you're probably seeing these numbers and thinking, oh, well, those don't look so bad going forward. The war has a short-lived effect. Why have the forecast for 2023 not been lowered more? We get asked this a lot, but no, it's really not a short-lived effect. In fact, it's a permanent output loss. So you're not having a strong rebound in 2023. So essentially, your output is going to be on a lower trajectory path than it would have been otherwise. And that's not expected to be unwound, unlike what we saw for the pandemic, especially in Europe and Central Asia, where we saw a really strong recovery. We're not expecting that this time around, not this year, not next year, or the year after. And speaking to the region in particular, these downgrades are especially pronounced in Europe and Central Asia. This again has to do with the large negative spillovers and from the tighter economic linkages, particularly with Russia, but also with the Euro area, which has been deeply impacted by the war. And as far as the subregions go within Europe and Central Asia, we've seen that the hardest hit countries are those in Central Asia, which had been pretty resilient throughout the pandemic, but also the commodity importers in particular. And that's because of the sharp rise in prices due to the supply disruptions and what's going on with global commodity markets. And so this is a pretty weak outlook in general, but it's still subject to downside risk. And it could get worse, unfortunately. So we put some of these numbers into context. So on the risk side, we modeled on financial stress, the risk of an energy export shutdown to Europe by Russia, and the risk of reoccurring COVID lockdowns in China every 2 quarters. Now, without getting too much into the weeds on the modeling details, we essentially found that if all 3 of these risks materialize, it would bring the global economy to the brink of a global recession, at least in our technical terms. This would reduce growth from what we had envisioned in this last slide here, 2.93%, so around 3%, to about 2.1% this year and 1.5% in 2023. So much slower than the baseline forecast. And we did a similar exercise for Europe and Central Asia, where we pretty much modeled what would happen if the war essentially triggered a shutoff of energy to Europe, to Euro area in particular. And we found that the outcomes for forecast would be a significantly steeper downturn, about twice as steep, in fact. But of course, there's other risks that could materialize, and just really heightens the case for the need for economies to build resilience within their economies. So one of the large threats, which I think is very appropriate for these seminars, is that global temperatures are rising, and this underscores the need to tackle climate change. In the face of steadily rising global temperatures, we could see really long-run economic consequences from inaction on the climate change side. And as you see here in the right-hand chart, although consumption of renewable energy, which has largely been on the solar and wind power front, it's increased quite a bit in the last 2 decades, investment in green energy is still not sufficient to reach climate goals. So this points to the need for more financing, both on the public and private side. And, I know I talked about all the downsides going on in the global economy, but there are a lot of opportunities that countries can seize during this green transition. And especially for the producers of commodities that are used for inputs in new green sectors, they could benefit from this, particularly some metal exporters, given that renewable technologies are metal intensive. But we have seen a lot of volatility in the market, particularly with energy prices, and this could also affect the transition toward low carbon technologies. The surge in energy prices that we've seen this year and last, that's increased the price competitiveness of renewables. So we're hoping that we could see more push on the investment side for solar and wind, and provide an incentive to invest in the low carbon energy sources, because energy prices have just increased by many folds. But this could also, the increase in energy prices could also encourage investment in the production of fossil fuels and energy exporters. So it's a fine balancing act. Though with European energy security kind of put to question by the invasion in Ukraine, the need for energy transition is all the more urgent. And the need to ensure food security is also something that's on our minds as well, especially as droughts, wildfires, and floods and other extreme events have only increased and make it more likely that those will continue going forward given climate change. And that can all stress the food system. And then, so second, I'm going to talk about the question at everybody's mind and what this means for financial market implications, especially with lending. So returning back to our long list of risks, we'll focus on stagflation. So we've seen, everybody has seen it at the grocery store, that we are experiencing inflation again. It's back, and we had expected it to subside at the global level at some point in H1 earlier this year. But of course, with the invasion, we've pushed that out further. And so now we've seen that inflation continues to accelerate, especially in our region in Europe and Central Asia. Although I will point out, even before the war, we hadn't expected inflation to slow down until later this year for ECA in general. But on the global side, that's what's been surprising, is that inflation continues to surprise on the upside. And this is largely due to external factors. I mean, commodity price shocks, especially after Russia's invasion of Ukraine, and then with the lockdowns in China exacerbating existing supply bottlenecks. So in short, what we had expected to be unwound by now back in January has persisted. But as I said, for Europe and Central Asia, we had expected inflation to remain elevated anyway, so not so much of a change to that baseline. What's changed is our assumptions on the global side, which will affect the financing opportunities for the region. And I mean, we've seen this everywhere. Inflation is exceeding target pretty much in all inflation targeting economies. That's been the case for Europe and Central Asia as well, pretty much since last year. And we did some simulations using the Oxford economic model and our baseline forecast. And essentially, we're expecting inflation now to peak in mid-2022 and then gradually decline to about 3%, which is about 2/5 of the level in April. And that should happen by the middle of next year. And that's largely due to energy prices stabilizing, hopefully. And so what this does is it creates a very weak growth environment for investors. It's not only on the near-term side. So I know we're kind of short on time, but I wanted to mention that essentially the market doesn't hold a very optimistic view either for the longer-term growth prospects. This could make investors more risk averse going forward and limit financing opportunities for emerging market and developing economies, especially for those perceived as being more risky, which we've seen to a large extent with our client countries in Europe and Central Asia because of the war. It's really hit confidence hard. So this is important to flag. And now everybody always wants to compare our current episode to the 1970s. And of course, a steep global slowdown, growth slowdown, coupled with high inflation does, ring similar echoes from the 1970s stagflation that we saw. I mean, we had the 5-fold increase in oil prices and a near doubling of food prices. And this is kind of what we saw in the 1970s. We had large increases in energy and food prices, and we saw a triggering of the global recession in 1975. Now, the recession rebound that we had last year has helped insulate somewhat, but we still weren't completely there yet. And we are seeing that, for instance, this global growth slowdown, it is the last thing the economy needed was the war in Ukraine. And so what we've seen that preceded all this is that real interest rates turned deeply negative. And this isn't a short run thing. This is something we've seen in the decades leading up to the pandemic and after, especially after all the significant accommodation was put in place by macro policymakers. And so on the left-hand chart here, you can see that the real interest rates turned deeply negative. And this contributed to a large run-up in EMD debt, not only in the past decade, but also in the decade that preceded the 1980s. So we do have some similarities that we are monitoring. And that not only that is, so I mentioned how the debt run-up has coincided with the negative real interest rates, but also we've seen that the composition of debt also leaves emerging market and developing economies more vulnerable than in the past. External debt remains elevated, and there's pronounced exposure to both foreign exchange and rollover risks. So again, a lot of risks there. But there are some positives, now versus then. We arguably, the most important thing is the transformation of monetary policy. We had advanced economies back in the 70s, just exiting Bretton Woods, and EMD central banks were still pegged in an exchange rate regime. But now most central banks, major central banks, prioritize price stability. They've increased their transparency, improved their independence, and their inflation targeting credentials. And that's really helped anchor inflation expectations, which you see on the right-hand side. In other words, it doesn't take as much policy response now to re-anchor those. So that's been a positive development versus the 1970s. And so hopefully we're hoping that central banks can now capitalize on those decades of building credibility, and that financial markets, will still continue to believe that central banks can quell inflation with smaller rate increases than was necessary in the past. This would mean that the adjustment is smaller and therefore less painful. And so I'll just kind of go over this real quick. We do have lower inflation pressures than we saw in the 70s. The wage growth, for instance, is a bit lower, but there is always, of course, the risk of a wage price spiral. But given time constraints, I'll just go quickly. Monetary policy has been tightening in response to inflation. This includes in our region in Europe and Central Asia, which started the tightening process relatively early compared to peers in emerging market and developing economies. So we're hoping that this could nip any prolonged stagflation period in the bud. And then also go quickly through this. This might not be enough. You see here on the left-hand chart, for instance, we had previous policy rate increases during tightening cycles. And you can see how high core inflation was at the beginning of each cycle. And this current cycle stands out in particular. For this level of core inflation, for instance, in the left-hand chart, markets are expecting a very muted tightening cycle. However, this could surprise markets again, and we could see a sharp increase on that last blue bar in the left-hand chart. And so what brings the end of the stagflation is usually a global recession. Policy tightening in the past has brought down inflation, but it also has triggered global recessions, which we saw in 1982, where global per capita GDP fell by more than 1%, and half of the world's economies went into recession. And we could be looking at a similar, this isn't our baseline, but this is a risk, a downside risk. If all these kind of bad conditions materialize, we could have adverse repercussions for capital markets, particularly for investor sentiment. And in turn, we could see another decade of growth and investment disappointments like we saw in the 2010s following the global financial crisis and the European debt crisis. So against the backdrop of a weak growth environment and sizable investment gaps, an erosion of investor confidence could limit Europe and Central Asian economies, the ability to access financing, the financing that's needed to achieve these climate change goals and the green transition. And this is especially the case in countries with a riskier market profile where financing costs are in general higher. And so very quickly, I'm going to skip through a few different things on the policy side. So on the national policy priorities, one thing I want to focus on is that, we know that stagflation is a really naughty policy problem because the remedy to high inflation usually has the unpleasant side effect of reducing growth. But one of the big lessons from the 1970s that we've learned is that delayed macroeconomic policy responses in general means a larger adjustment period. And so that's where we have the good news is that many central banks are prioritizing price stability and they have been acting on it. And they are clearly tightening policy now. So hopefully that will prevent worse inflation outcomes, especially on the more medium-term side. But it's also one of the reasons why we are expecting a steep global growth slowdown. And it's going to take a lot more to reboot long-term growth. But of course, with policies that complement long-term growth, they can also complement economic resilience from a climate change side. So try not to be all negative here. But let me focus on one set of policy challenges in particular, especially in our latest edition of Global Economic Prospects. We have a bit of do's and don'ts of dealing with energy and food price shocks and what it means for the green transition. Unfortunately, though, so far, the policy responses has been largely distortive. So we've seen at least 70 countries implementing subsidies or tax cuts, given the increase in commodity prices. And some are even toying with the idea of price controls again. we see really large fossil fuel subsidies still in emerging market and developing economies. And this is before the increase in energy prices. The data lags a bit. So this chart on the right-hand side is only going to be larger. So you can imagine too with the fiscal position of many governments that they face after the pandemic is really weakened. And they're also spending a lot of money still, and even more now because of the rise in prices, on subsidizing fossil fuel demand. So this is a problem we definitely see at the World Bank. And so what we are encouraging is really to focus on targeting vulnerable groups with income support rather than with subsidizing fossil fuel demand. And so what we've seen in the 1970s, we have some good lessons we could learn from there that I think not only apply to the increase in commodity prices that we're facing today, but also to some of the challenges that are spilling over from the war. There is a better way than subsidies and boosting demand for fossil fuels. In fact, the most effective policies are those that encourage more efficient consumption and larger, greener new supplies of energy, which can also have positive benefits on the energy security side. So take, for example, the experience of the 1970s oil crisis, soaring prices on the energy front. While it did bring on new production of oil, it also triggered policies to reduce consumption. The US and others imposed and tightened fuel efficiency standards on cars and home appliances, and the things like lower the speed limits in the 1970s. And since then, what you see here on the right-hand side, per capita energy consumption has fallen sharply, and oil consumption even more sharply. And today, further efforts can be made, especially on the Europe front. I think the IEA highlighted a 10-point plan on how to reduce energy consumption and demand in the shorter term to confront these growing risks that have been generated from the war in Ukraine. And encouragingly, many advanced economies are putting in place packages to address investment gaps, including those related to the green transition, which could really help not just only tackle climate change, but when you have these public and investment programs put in place, especially in the European Union, there's been research that has found that it also, instead of crowding out private investment, actually crowds it into a certain degree. And that's based on IMF and European Commission papers, research that's been done. And so even in advanced economies, we still have investment gaps. And so there could be some productivity enhancing investment on the public side that could boost potential, could also have complementary effects on productivity. Scaling up policies, especially to discourage carbon emissions, can complement these investments, such as taxes on energy use, carbon taxes, and tradable emission permit pricing. So these are also important to ensure a smooth green transition. So not just on the public side, but you also have to have on the fiscal, not just the public investment side, but also the fiscal policy side. And especially given the limited fiscal resources for many economies, policymakers can target urban areas, for instance. Those are the areas really at the forefront of climate change. That's where 2/3 of the world's energy consumption happens, and 70% of global CO2 emissions occur within cities. So not only targeting public investment, but regulations that focus on urban centers could have large dividends on the climate front. And so we talked about, to just summarize, we talked about what the global economy is facing with particular focus on Europe and Central Asia, and what it could mean if some downside risk materialize. We discussed inflation and how that could deteriorate the investor sentiment and outlook further. especially on the financing side, which would directly affect green financing. And then in the short term, discussing the balancing act, is very difficult balancing act that policymakers have between bringing inflation within target without causing a recession. But even if they exceed, growth will still need to be boosted with reforms. And what a perfect opportunity for those reforms to be green and to focus on areas of energy security and the food supply to make the economies more resilient. And I think the 1970s is nicely illustrates the long-term effects of the right kind of reforms that encourage energy efficiency and greater supplies. And thank you, and I will turn the floor back to Michaela.
Thanks a lot, Collette, also for being with us, as I see on your screen, very, very early in the morning. So thanks for this. Also for giving us the reality check in a way. What is the current situation? What is the outlook? And unfortunately, it does not look very rosy. So I think we should focus on the positive messages you've had of that there are a few opportunities also coming out of the current crisis in terms of the green transition, and that we should, from the public and the private side, speed up the green transition as fast as possible to deal with this crisis. We'll have a Q&A session after our next speaker, who I see already here on the screen. Mr. Sean Kidney is with us today. He's the CEO of the Climate Bonds Initiative. I understand he is the world champion, or one of the world champions in working to promote green bonds. So I'm very excited to have you here. Unfortunately, I cannot play in any background music because that might be the right moment to do it. So the floor is yours. We look forward to hear about alternative solutions. We've heard already a bit about green bonds before, but I understand you will also talk about transition bonds and sustainability-linked bonds, and also tackle again the question of standards and taxonomy, which was raised beforehand already. The floor is yours. You're muted, so it does not only happen to me.
The classic example. Thanks you so much. Thanks for having me here. I will cover my presentation fairly quickly. Got a couple of slides. I'm going to encourage people to ask questions in the chat or afterwards, because what counts is whether I address your concerns and your issues rather than what I've got to say. And if someone wants to put up their hand, I've got a few old friends on this call who will be very used to the idea of putting up their hand and telling me to stop it and move on. Please do so. Look, there's a few things. Context first, and Collette, great presentation. There's some rather substantial economic winds blowing. Some of those economic winds are very clear when it comes to the green space. Collette talked about a few of those aspects. And those opportunities in terms of transitioning our economies. I particularly take the point about urban transition. The bulk of assets we have in society are urban assets. Property, for example, is 2/3 of asset value globally. If you exclude derivatives and financial instruments and so on, they add up to everything, of course. So when we look at greening financial markets, that's very important to know. It's also important to note that when we look at the changes we need to make and take our International Energy Agency modeling, 40% of emission reductions we have to achieve the next 30 years to meet our climate goals are in building assets and property assets. That is urban development. So there's a real conjecture. And then, of course, all the other investments like clean energy, industrial, are largely urban related. There are, of course, many things that aren't urban, but in terms of asset value, it's relatively small. So the nature of our economic policy for urban development is utterly critical to how we're going forward. And of course, the nature of our rebuilding efforts in Ukraine will be totally dominated by urban rebuilding activities, because the nature of destruction that's happened, because people of artillery tend to bomb cities, etc., etc. So you can sort of see that the whole urban agenda is really got to be dominant going forward. And of course, it's worth noting that larger urban centres have much higher productivity levels as a rule than the rest of economies, and they are wealth creators. And there's a whole body of literature now out there about how to construct the right kind of urban environment to maximize productivity gains and wealth creation. You know, look at books like the Richard Florida's book on creative cities and so on, and you will see some of this work. So there's a really rich agenda, and thanks, Collette, for pointing it out to us or alluding to that. The other important thing to note has been this shift, the drastic, dramatic, critical shift in major economic commitments to addressing climate change in the last 2 years. At the Biden Climate Summit last year, for example, we had all the world's major economies commit not to 2050 targets, but to 2030 emission reduction targets. That is an extraordinary change, utterly extraordinary change. And of course, Europe has committed to 55% reductions in emissions by 2030. So the changes in these major economies, you know, some of them won't get there. Hey, that's going to happen. Of course it is. But they're all saying the same thing. So the direction of travel is now absolutely clear. And when we talk to global investors, and we have about $45 trillion of assets under management in our global partnership program amongst investors, they are all saying the same thing, like songbirds singing the same song, which is the shape of the future is now decided. It's only a matter of the speed of the change. Of course, in terms of avoiding our climate catastrophes that we're currently facing, speed is everything. We do need to achieve those 2030 targets, but the shape is clear. We are becoming a clean green world, and that has significant, substantial implications for all economies in terms of their export revenue, in terms of the nature of how businesses are going to change and what that means for demand, for investment, for the kinds of things you're going to be able to buy are going to change. So we need to understand we're at the still relatively early stages of now what is a certain revolution, not a possible revolution. We can start making decisions in a way we have not been able to make decisions before as a result of that. I'll talk a little bit more about the implications as we go forward. The other thing that's happened as a result of these changes in major economies is the increased support for green transition that's beginning to happen. I'm going to start using the word transition now. All economies we're dealing with have embraced the term transition. The Japanese government, for example, has put out principles of transition, and they've announced they're going to do a sovereign bond issuance program, which is called Green Economic Transition Bonds, $157 billion worth, by the way. It's quite a large program. This concept of transition is now well understood. The detail, of course, that is a challenge. But the support for these kinds of activities are now becoming mainstream. Of course, we've got the World Bank's substantial support for green investments going forward. We have the European Investment Bank that is now calling itself a climate bank. 50% of all lending has to go to green. And the EBRD, thanks to my friend Joshua Tanaka before he left last year, the new climate policy shifts to 50% green. And in the EIB, in EBRD's case, it's not just the 50% going to climate, the other 50% has to address resilience and climate risk as part of its work too. So in a sense, they're becoming 100% green institutions. And it's not those. I mean, I just come off a call with the Asian Infrastructure Investment Bank that are looking at how they can shift all their investments to be going green. Chairman Jin announced at our conference last year, no more coal, and now they're shifting to no more gas, in line with President Werner Hoyer of the EIB's comment that there is no future in gas, gas is dead. Now note that comment, because what you're seeing, the underpinning there, is a growing body of work globally to define what it is that are the right kind of investments going forward. In the context of very short timeframes, remember 50%, the IPCC says 50% cut in emissions by 2050, or else frankly, we're toast as an economy, as a society, as a global population. We need to know what that means. And we're discovering things as we learn. So we now know what level of ambition in the green property sector we've got to achieve, thanks to work done by IEA and OECD in the past, that is adequate to the challenge and inadequate to the challenge. This is being reflected in projects like taxonomies and rule sets and so on. We know in the energy sector, we don't have a space for transition fossil fuels anymore. The window's closed. It's too short a period. We need to actually leapfrog to clean energy. We can't afford to go coal, gas. Plus, we've discovered that gas has huge methane leakage on the pipeline system. So we know from Russia and Turkmenistan, there are huge plumes of methane. And methane is 84 times as potent as CO2. It is a disaster. You get a 3% leakage rate across the life cycle. And hey, just leave the coal plants in place because they're actually the same emissions level. So this is a new understanding, which is reflected in Bruno Heller's comment from the European Investment Bank about what is climate related. You know, the World Bank used to fund a lot of gas 10 years ago, and now it's disappearing from the portfolio for these reasons. So these are really substantial changes that we're in the midst of seeing. And of course, in the Ukrainian circumstances, that's reflected in the work of the Ministerial Committee looking at building, which has got a really strong component of building back better, of greening it. Now, what will that mean? Well, I'm going to tell you in energy, it means we're not going to be putting gas central heating in buildings in Kharkiv again. That's gone. We're looking for electrifying everything. In fact, understand that electrification is a really critical part of the green transition. We need to quadruple our electrification globally in the next 30 years. Quadruple. So it means not only we're talking clean energy, we're talking about all the infrastructure for electrification. And in the European taxonomy, which I've been one of the architects of, grids are part of it. So grid investments. So we heard a great story from George and Rael. We heard from Bank. We haven't heard from any grid operators yet. Every single green operator in the region is a green bond issuer, as far as I'm concerned. They haven't done it, none of them done it yet, but they should all be doing it. It's not about assets to a solar plant. It's about their entire asset portfolio, with the exception of a line to a coal plant. That doesn't count, but you know, minor exclusions. These are new understandings. These are being reflected in the work of the region. The investor appetite is extraordinary. You heard from Georgia Rail about their investor diversification, their oversubscription rates, but this is repeated again and again and again. Of course, it's US dollar and euros, and you heard Paul Horrocks talking earlier about the greenium that's appeared, but it's not just that US dollars and euros, Paul. When the Chilean government did the US dollar and euro green bonds, they got the cheapest interest rates that ever achieved in history. But then they had a peso one, and they got the cheapest interest rate that ever achieved in history as well. Last year, before the conflict that we're all just roiling our world, I was on a panel with the deputy mayor of Moscow. They issued a bond, $700 million worth in rubles, to finance Moscow metro development. And they got a 20 basis points advantage in Russian markets from Russian investors to do a green bond. We hear this story everywhere. In Egypt, the Egyptian green sovereign is trading in secondary markets. It's a 75 basis points benefit to vanilla. It's everywhere, folks. Now, data's not there half the time because there's no direct comparison, or there are other markets, there's no discovery. So it's complicated. So I can't point you to a report about all those other currencies. I can point you to the reports that Paul cites in US dollars and EUR, but this is a global phenomenon, is my point. Because the investor appetite is huge. When I spoke to my friend Paul Bodnar in BlackRock recently, who's the global head of responsible investment, he said to me that he got a shock when he started, because he's a climate guy, had worked in the White House before. He discovered that green bonds was the biggest thing that BlackRock had ever done in terms of mobilizing their clients' interest in doing something. It's simple, it's clean, it's easy for people to do, and that's why it's worked. Yesterday, I was speaking to my friend who used to be the head of green bonds at JP Morgan, and she said that after 10 years of fighting management to get more green investments and more climate focus in, she says suddenly, to her distress in a way, everything's green. The whole organization is going ESG because it's taken off with sustainable investments. They're hiring people left, right, and center. And she's a little annoyed because they're hiring a lot of show ponies. Okay, that's what banks do. Fair enough. The point is, it's gone global. And the green and sustainable bonds market is the evidence of that. We now have a market that is $3 trillion in size, 3 trillion US. This is not an insubstantial market, folks. this has become rather mainstream. It's spun off the daughters of green bonds market. Green bonds, use of transparency reporting, the rules are basically set. And we've seen social, notably the European social bond program, which finances employment relief in a crisis. We've seen sustainability. We've got blue bonds, transition bonds. I'm going to talk a little bit about that. So look, that's the context. This is a rather major context with extraordinary opportunities for the region. And it's way beyond bonds. It's debts, it's short-term paper, it's equities. The conversation I'm having of Asian Infrastructure Investment Bank is about equities. They want to support equity investments in the region, their seeding funds and so on. But it's all a common theme and a common universe of description. So the developments that count are that common universe of description, taxonomies. This isn't just in Europe, it's also in China, which was the first one, in Russia, who adopted a taxonomy in September in the Duma, which mirrors the EU taxonomy. It's in South Africa, in Colombia, in Singapore. We've just produced, and we've been working on all of these, we've just produced the Singaporean taxonomy, etc. So it's kind of everywhere. It includes a range of kinds of investments. So it started off being green, I said sustainability, we've seen blue bonds, water investments, marine protection. The Dutch sovereign green bond was in fact a resilience blue bond was coastal protection measures and so on, etc. So you can sort of see there's a kind of fractal complexity developing in the sector under the broad rubric of what we've got to do to address our future challenges, with climate change being the freight train coming down the tracks. Climate change is a dominant issue that we have to start addressing here. In the EU taxonomy, we've got clarity, which has started becoming normalized in a range of areas. Clean energy is in. It's very easy. Grids, I've already mentioned. CCS, nuclear. There is a proposal before the European Parliament right now, still contested, possibly going to be defeated next week, but we'll see, to include, add on, nuclear and gas. Our line has been very clear. Nuclear is low carbon. Don't have any doubt about it. Nuclear bond sell. We don't certify nuclear because we think it's a crazy investment, stupid investment. There's no financial sense to it. But hey, if you're going to do it, it is low carbon. Gas is not. The European proposal for inclusion gas is actually extremely tight. Hardly anyone can do anything. There'll be none in Eastern Europe. It's exclusion. But the headline's bad. The messaging is complicated. That's what we're trying to defeat it. But bear that in mind. Exclude the criteria are very, very tough. They're essentially not part of it. Transport, zero tailpipe electric, rail is in. There are forestry, there's manufacturing investments, there are property investments that are big. And this is the big opportunity, I think, for banks in the region to be able to look at how to identify which property portfolios will qualify, or real estate investment funds that are shifting, that are transitioning to low carbon, that are moving their portfolio. They would qualify as well. And these are the things we need to try and explore going forward. But Climate Bonds Initiative has a certification program that's used across the area, just to let you know. And we're looking at how we provide certification that's interoperable between all the various taxonomies happening around the world, which are broadly in line, but have some differences going forward. Included in this now is transitioning. So transition means kind of three things. It means a company that's seen as brown, like a Shell, that invests in renewable energy. That's one kind of transition. So they can do use of proceeds bond. It might be a steel company investing in electric arc furnaces that are currently fueled by coal-fired power stations, but are part of the future. So it's the right infrastructure of the future. That's a different kind of transition, but that counts as well. Or it might be an entity, a steel company again, that has an ambitious corporate strategy to shift to producing green steel, like SSAB in Sweden, and that would qualify for what we call an entity certification that's coming through. So there's a variety of aspects. The main thing is it's all about how you shift high carbon companies or existing businesses to being adequately consistent with what we have to do for climate change going forward. So it can be property, it can be transport, it can be industrial applications, it can even be agriculture. In some of these places, we have the rules in place. In other places like agriculture, we'll be rolling out more rule sets over the coming year. It also includes resilience. So we've seen the terrible cost of not being prepared over the last 2 years of COVID. We now know there are things we have to do. It's not just what the Dutch government done preparing coastal protection in the context of climate change, the physical side of resilience. It's also social and economic resilience. And this is primarily the UN Sustainable Development Goals. Well, they're indicators. They're not actually a taxonomy. They don't give you enough solid guidance, and they're as flaky as hell in some places, but it's the right direction. So what we're now looking at doing with the IADB and the UN Disaster and Resilience Recovery Fund, developing clear taxonomy around resilience issues, which should go beyond the physical issue. You know, we now know, for example, investments in primary healthcare are critical to surviving pandemics. That pandemic, by the way, biodiversity destruction in China, guys, this is human impact on the planet. So it's all related, and it's been predicted by the IPCC Health Committee for 30 years. We're going to get a lot more pandemics. We've got to prepare. How does our health system get designed to be fit for the next pandemic? How do we ensure vaccine production can be rolled out quickly and shared, by the way, with emerging markets? So we don't just give it to Americans and to Europeans, but people in South Africa get it as well. All of these are design issues that we can start now bringing into resilience criteria. Economic measures that ensure a country can bounce back are really important. And, you know, we now know from studying for 70 years, including huge amounts of World Bank research, that there are very clear measures to take which have a dramatic impact on resilience, such as the education of women. If you educate women, they participate more in primary, I'm talking about not tertiary, I'm talking primary education. They participate in the economic life of society in a way they don't otherwise do. And that reduces inequality and increases their ability to be able to respond to crisis. The more people can read and write, the more they're able to manage resilience. There's in fact a great story in the Economist magazine this week about this very question, which I commend to you, to explain how resilience and the relationship between resilience and primary education works in developing countries around the world. You can sort of see where the resilience agenda is going. It's not just water infrastructure, although that is important. So this is the next frontier for the taxonomy work, and you'll see more work over the next year, which will open up opportunities for issuance in countries in the region, both sovereign issuance, but also potentially corporate and other institutional, and certainly subnational issuance going forward. The other development that is worth noting is around instruments. You know, I mentioned in my question to George and Robert earlier, short-term paper. We'll publish a paper in the next couple of weeks about using commercial paper, short-term paper of all sorts. It's a $55 trillion market. It's going to be green as well. There are transition bonds that I've mentioned, transition loans, but there are also sustainability linked bonds. So these are bonds where an entity issues a bond, but it can also apply to other instruments, with a promise to achieve certain outcomes and a penalty attached to the coupon if they don't achieve the outcomes. I mean, look, if you're a treasurer, you know it's marketing. You're not really going to commit to a goal which you don't think you've got a very solid chance of achieving. I understand that, but they're quite popular. And so let's go with it. Investors are liking the idea that the entity commits to a promise and has a downside risk if they don't get there. Of course, what our challenge is assessing the promise, and what we're working on is, and again, that transition idea of, are the corporate strategies that are being unveiled here adequately ambitious to the challenges we face? You know, a promise to improve the emissions performance of my portfolio by 5% is frankly not worth the paper it's written on. Get out of here. But we have seen sustainability bonds along those lines. So what is the right kind of issue? Well, actually, if you're working in ICT, 5% might be okay, might be. If you're working in steel, it's nowhere near enough. So there will have to be sector-specific transition pathways. And for that, we'll be working with the likes of science-based technology initiatives, science-based transition pathways, et cetera, et cetera. So that gives you a flavor of the sort of things. I wanted to finish up on asset discovery, because there was a question that came up earlier. What do we use in the portfolio? I've tried to say energy is not just clean energy, it's grids. There will be, we're not there yet, some kind of oil and gas investments, which are to do with the sweating the existing assets, reducing emissions, stopping that leakage factor on pipelines, and for example, but no new, do not expect any new. The IEA kind of killed off that idea last year when it published that net zero report, said that under a 1.5 degree, we cannot do any new fossil fuel investments. It's just not possible to do extraction or generation and make the numbers work. So they're not going to qualify. But under existing, we've been working in Canada on what you might do to reduce emissions in your existing network without necessarily increasing the tenor. That's the challenge. But, there are some things there. Transport you've heard about. Property you've heard about. Our challenge now is to popularise and promote labelling schemes which tell us what buildings qualify. In the EU, we're doing this. In the region, we've got work to do. This is something where EBRD, on the call, can help us here. And not to mention the OECD, of course. Industrial changes, industrial trend. There's a huge portfolio of industrial investments need to look at. Land use and agriculture, and of course, resilience. There are complications still. In the EU taxonomy, we're conscious that there's a bit too much complexity. So we're trying to do some reform work on that to make it easier for people to use during the course of this year. So watch this space. The key thing is we have got a global discussion about what is green and what is transition now. We do need to do a little bit more work to support the sector. Thank you again, EBRD, but also thank you, AIIB, thank you, World Bank, thank you, IFC, for their technical assistance program. Thank you, Asian Development Bank, got a big technical assistance program, and I was on a webinar with them yesterday about it. This is growing, and this will grow. And we've got banks in Georgia, for example, that are looking at benefits of a current EBRD program of support. We will see guarantee funds coming out of the Netherlands, coming out of the major banks, and the IFC, and so on is providing these. If you're doing a green bond, you can get a credit guarantee. Now, look, there's a cost factor, but generally it'll give you more access to investors if you get involved. And of course, some of that will become cheaper because governments like the US Treasury, US government are stepping in to increase the allocation in this area. You will see a whole ecosystem of verifiers helping in this space. For example, I can commend you to EY in Kazakhstan, done a good job of developing capacity in this to be able to do green bonds in the area. And there are similar people all around the region. And you will see a lot of training work, Climate Bonds Initiative Office, green bond training, if you want to know more. And I don't want to forget my friend Harold, who's on the call from TCX. You will see targeted currency hedging support being normal. But there are challenges. Of course, there are challenges. We're trying to change the planet here, and we're trying to change it in a few short years. There's going to be challenges. But don't forget that the appetite is extraordinary amongst investors. You will get the demand. It is worth engaging. It's important to engage because this appetite is not going to diminish. Collette's report is not going to diminish that appetite. It's going to increase the preferencing because in a time of risk, what do you want to do? You focus on stuff which is future-proof. You focus on stuff that's got less likely to be negatively impacted going forward. And what is that when you know what the shape of the future is? It's green. It's transition. You will see more demand, more support for this, not less. So everyone, time to get on the train.
Thank you very much for this upbeat presentation. I think it's excellent how the two presentations have been put in the same session, because I think one was, as I said, the reality check where we unfortunately stand right now, which already hinted at some opportunities, and you really picked that up, Sean, and developed it further. And I think there's a lot to, a lot of indeed opportunities there which we can use. You say we're already moving in the right direction. So yeah, I'm much more positive now than still a bit beforehand. No offense, Collette. It was your task to outline the reality, but I think it was very good that we saw the two sides of the coin in a way. And with this, since we're already a bit running behind time, I'd like to open the floor for questions right away. And there is a hand. Alexander, floor is yours.
Yeah, thanks. Wonderful presentations from you both. Thank you. Just wondered whether Jean could elaborate a bit more on these alternative instruments. I mean, what we found in the 7 countries that Taxonomy alignment is a little more challenging outside the obvious sectors like renewables. So transition bonds, as yet, I think are a bit marginal, but they would essentially require a very credible commitment on a climate path by the issuing corporate. And equally, sustainability linked instruments, you need to have faith in the corporate governance of the issuer, that they actually, they track what they commit to, and they deliver, and that targets are actually stretching and having impact. So I wonder, would you think those two instruments are more suitable to the Eastern Europe region? And if so, which countries, or what preconditions in corporate governance and transparency would you like to see?
Look, the framework, guidance and framework is still in development, to be very clear. You've picked the right points. We need adequate ambition and so on. In some sectors, that guidance in there, in the European taxonomy or the climate taxonomy, we have transition pathways which give us the framework which do this, like in the property sector. We've got to identify, but at least the pathway is very clear. In the European taxonomy, the Commission kind of squibbed on a major demand we made at the technical expert group at the last minute, which is they took out the forward guidance. And they just said the transition pathways will be reviewed every 3 years. Yeah. Because what we needed to say was, this is what steel and buildings will be in year 5, year 10, year 15. So we've got a bit of challenge working around that. But look, all of these things are part of this being guidance in development and guidance coming through. We have published a paper called Financing Credible Transitions on our website at the Climate Bonds Initiative, which gives you the framework. If people are just in line at that, show how they're 1.5 degree aligned, don't use offsets, their contracts, not promises, those kinds of things, you're already on the way to getting investor support. And I can point you to direct investors. So it's a developing framework. We have the skeleton there. We do need to provide more detail, and you'll see a lot more detail coming through during the course this year from ourselves and from other organizations that are working on this space. It will work, it can work in the region, but you're going to have to familiarize yourself with the guidance that is available and the guidance that's still in development as part of getting there. So there's a little bit of a transaction cost I appreciate for the moment until those guidances become really clear. Hope that makes sense, Alexander.
I think he's satisfied with the answer. Good. Any more questions from the floor? I do not see any more virtual or physical hands. Then I would have a question. I mean, you both touched upon Ukraine and green reconstruction in Ukraine. I don't know if you were there this morning when my deputy head of unit was giving his little opening remarks. We also refer to that because, for us, this is really very much on the, let's say, political agenda right now. I mean, understandably, Ukraine does not want to wait for this horrible war to be over. We want to start with the green reconstruction now. Obviously, this is a bit of a moving target because, of course, in terms of what are the financing needs, etc., this is changing by the day with the war going on. So I just wanted to see a bit from your side, well, maybe a reality check, how you see it. Because for us, it's really important to have indeed this green reconstruction. You were talking about the housing sector. If we rebuild, we want to rebuild green, energy efficient, etc. So I just wanted to dive a bit more deeply into that and have your view on that, and how to, if you have any ideas how to go about that concretely, because of course we want to do it. But I think we're all like, okay, how can we already advance on it now, for instance? So that would be my question.
I can take a little bit of the first part of the question, and I leave it to Sean's expertise on more of the operational side there. So I think building back better in the sense of Ukraine's reconstruction, it makes a lot of sense, not only in terms of the green transition and this resilience that that Sean rightly focused on, but also from a more traditional economic side. So Ukraine, even prior to the war, had really, really, really low productivity, among the lowest in Europe and Central Asia. So I think with green investment and building back better on the reconstructive efforts, it's not only an opportunity to boost this green transition in the region, but it also presents an opportunity to boost potential growth and to boost productivity. And that's really important for income convergence, for catching up, to escape this middle income trap that the World Bank has talked about for decades now. So I think in that sense, crises, especially in conflict zones like this, it's really hard to see any silver lining. But on the upside, from the reconstruction efforts that are going to proceed, we could do a better job at ensuring the future and future growth and sustainability.
There is that old Chinese adage, of course, every crisis, never waste a crisis. While it's ugly at the moment, it is also clear that all our societies and economies need a reset. And the Ukrainian has a very sharp reason for a reset, right? When Kharkiv is totally destroyed, it's kind of stuck of a reset. So as we reset with a different set of perspectives in mind, which is what the world needs to look like and what it will look like going forward, and the opportunity to leapfrog. So there is, I hate to say it, a kind of opportunity. Don't get me wrong, got to get the money. So that's the hard part, right? But in terms of whether we get the money or not, imagining what we're going to do in Ukraine going forward, of course, has to be informed by the certainties that we now understand about the future. Think about it that way. All it is designing a future that is fit with the world we're going into and the world we need to get into. So we're going to have to build in a lot of resilience measures because we're stuck now, several rise. God knows if the steps in Odessa will be underwater in 30 years' time or not. We need to get the scientists in to tell us the answer to that and build accordingly around the coast in Ukraine. Like that's just like common sense, right? Nothing particularly complicated about that. It also applies to how the economies are developing. We know the demand for gas is gone. It's only a question now whether it's going to take 5 years or 45 years, but it's likely to be 15. Realistically, that changes how we use our economy. It changes what the pipeline authority in Ukraine does. It's just an understanding of the way the economy is going now that arises thanks to the Biden summit, etc. And plus we have a geopolitical reason to address that question. So when we rebuild in Kharkiv or Mariupol, it's going to have to be with electricity, not with gas. Oh, duh, really obvious. But it also applies to agriculture, because when we look at commodity exports, we need to be thinking about what demand changes are going to occur in the next few years and what we can expect to see and how we can make Ukraine a leader. So in the conversations I have with Brazilian agri industry, for example, and we've got a big Brazilian program, it's all about pitching Brazil as a sustainability leader and how to improve practices across the board, including forestry, deforestation protection. Unfortunately, we've got a president who keeps telling people to break the law. But whatever industry is there, industry is very much understanding that their future global positioning in the key export markets they have of Europe, the US, and China will depend on them being seen as highly sustainable. Hey, that applies to Ukraine as well. So that means we've got to be thinking about our capex going forward in that particular area, and so on and so on. One of the discussions we're having Ukrainian group is around electricity generation. I had no idea, but there's excess power in the grid from nuclear and hydro, quite substantial, particularly off-peak periods. Whoa, green hydrogen. And in fact, there's a green hydrogen plan now. How we can use, or pink hydrogen and green hydrogen, pink from nuclear, green from hydro, is one of the plans that the committee is looking at, how we can use that to export that electricity as well, and all the interconnectors we've opened up between Ukraine and are opening up, and Europe will allow direct electricity generation. Plus, we'll be able to create green hydrogen to export to European industry, and possibly some primary production of industry growing in the area, etc., etc. So, like, you'd be mad not to be doing this, wouldn't you? Like, you'd have to be a lunatic not to take this into account. And that's really what green development in Ukraine will look like, making it future fit. I mean, there are some side benefits too. We'll be able to create much nicer cities with integrated transport and cycling areas and walking spaces, etc., by creating cities that are climate fit for the future as part of it. But hey, that's a side benefit.
Excellent. What I take from this is also keywords such as resilience, you mentioned beforehand as well in the presentation. And I think indeed silver linings is what we should take away from the session. There's always a silver lining. So thank you very much to both of you. Unfortunately, we have to move on to the next session